Good morning, lazy traders. Like, subscribe, share if you would like to receive dividend capture trading alerts and dividend capture trading discussions. In this video, while I display all 18 of my 2024 dividend capture trades, I will be discussing the purpose of my channel. Number 1, help those who wish to trade. 95% of all traders ultimately fail as traders. This is actually a very important thing to keep in mind, because if you're going to engage in trading activity, do know that you are treating the market as a casino. Even in the light of using fundamental analysis to successfully trade and being as patient as possible and as conservative as possible, you are still taking on a heavy risk of basically guessing what's going to happen next. To a large extent, you really are. Also know that trading is less successful than investing. Nvidia from 2020 to 2024, Tesla from 2012 to 2021 are two great examples of this issue. In no way can you possibly trade yourself into a 20x position over the course of 4 years. It's going to take quite a lot longer time than 4 years just to get, those kinds of results. But Nvidia was able to do that over a short period of time. This is kind of sort of one of those extreme examples of investors making in a big profit on their investment over a short period of time as long-term investors. Most of the investments in the market kind of sort of lag the average anyway. And a lot of investors are gravitated to a lot of those kinds of stocks that just kind of sort of languish. But if you're a careful, prudent, seasoned investor and you know what to look for, you'll beat trading every time. Trading is 30 times harder than buy and hold. And I kind of sort of covered this already, but you're constantly in and out of the market. You're constantly in and out of stocks all the time. It's much more difficult to constantly move money than it is to put it in a good spot. Most people don't have a technical mindset. Reading tea leaves, trying to figure out the direction of the market is very difficult. Technical analysis is also extremely difficult. Technical analysis is like a variety of different chart patterns that you're trying to understand, like a cup and handle. The stock drops, it sits flat for a while, and then it starts to rise again and rise kind of sharply. And then it tapers off to maybe like a 35-degree angle, and it keeps going up for a while. At that point where it starts to taper off and continue to rise, that's what they call the breakout point. So you're supposed to be able to read the chart and know that you're looking at a cup and handle. The other stipulations with something like that would be that it has to formulate and then it has to produce that kind of sort of pattern over a 6-month time frame. So you have to look through the charts and see what's going on to find that kind of trade. And usually those are kind of sort of more of your cyclical stocks would probably give you that cup and handle pattern. Another pattern would be like the Golden Cross, where the 200-day moving average is cheaper than the stock price is currently today on a 50-day moving average. That would be like the Golden Cross. And some companies hit that. SoFi just hit that a little while ago, and then they had a big breakout from like $7.50 or $8 up to 10 something already. It's better to, and this is why I say, as a long-term investor, it's better to recognize the buying opportunities and buy when the price is extremely cheap than trying to look for these patterns. I was borrowing money to buy SoFi at $6.50. Okay, now it's at $10. So I would really rather in that situation just be the long-term investor. That doesn't invalidate trading. It has its place, it has its purpose, but as an investor and trader, you kind of sort of want to balance where your money is and how you're working with it. But if you're into trading and you want to do a lot of trading, it's a lot of hard work, it's a lot of effort, there's a lot of things that can go wrong and do go wrong. And the best thing you can do for yourself is to mitigate those issues and have better success, because you're picking better companies to trade with, and then you're also keeping your expectations low, so you have a higher success rate. 2, be informative about what companies are good capture trade companies. I intend to do an in-depth analysis of strong companies that have growing revenue, not real strong growing revenue, but it has at least a growing revenue, has a growing share price, very stable share price. There's not a whole lot of things to do in the fundamental analysis of a company, whether or not it's a good fundamental, whether it's a good capture trade or not. But my work usually falls into, say, 2 to 3 capture trade possibilities per week for 52 weeks out of the year. What draws me to a potential trade in that week is pretty much predicated on a few factors, like how high is the share price on its 52-week or all-time highs? What's the company's financial situation going forward? Like forward-looking statements. What are they saying about the growth, the prospects? What were the previous statements looking like the past 2 quarters? Am I buying into a company that's got some strength with a stable stock price that's growing a little bit? These are the questions that I typically have as I'm looking at a stock, and it kind of sort of makes me feel like, okay, I got something that is worth trading, and it'll probably give me a return over the course of a week. And sometimes I buy it the day before, I go into the EX dividend date, and I walk away with my profit that day. So, a lot of these weaker companies that don't really have the economies of scale or the ability to produce and all that kind of stuff, sometimes they pay a dividend and the stock price just kind of sort of sits there and stays down for a while. So you have to kind of sort of be careful of where you're picking. 3, provide trade alerts that people can use even just on paper. My trades are real and open and is intended to provide understanding and direction. And the idea of all that is if somebody wants to learn how to trade stocks, this is a good way to do it. I don't really have too many other ideas other than seasonal trading based on the RSI and the Williams percent R oscillator. Those are twice a year, maybe 3 or 4 times a year, depending on what I'm looking at. If I'm looking at the Russell 2000, maybe 3 or 4 times a year. If I'm looking at the NASDAQ, maybe a couple times a year. But a lot of times you're still really not going to beat those averages with that trading technique unless it's a flatter trading index with a little bit of volatility, a little bit of extra volatility. The Russell is a great example of that. It grows maybe like 8.5% per annum, and your trades can give you over 30%. You just kind of sort of wait for a little 5% drop. You look at the Williams and you say, okay, it's flashing a buy signal. I got a decent drop. I'm going to go ahead and just buy in right here. And then when it flashes green for a little while, take your money out and just wait for the next dip. That's how that works. It's successful. It's worth it, but it's not everything that I do. So the last thing that I really want to make sure I do is catalog a recorded 10-year history of trading compared to the benchmark averages like the S&P 500 for sure. I don't know about the NASDAQ, but at least the S&P 500. The S&P 500 for the last 10 years has averaged a 15% return. The NASDAQ about a 25% return. It's pretty broad-based in terms of the averages and the returns that you get depending on what you're picking. So as far as I can possibly tell you, these trades are basically with an expectation that you are going to have a return based on what's possible. And I'm picking a lot of these companies that are just kind of sort of losers in a way. They're winners and losers at the same time. They're not going to beat the market. They're not going to give great returns, but they at least have stable stock prices. And I'm using losers to see how much I can beat the S&P 500. That's kind of the idea of what I'm trying to do. If I can at least get 15% per year out of dividend capture trading, then it's worth it. Because 15% is still crushing it in the market, and it's still worth it. I'm sitting at 23% right now. So, yeah, and that's for 7 months worth of trading because I had the last 2.5 months off. So, yeah, it's a great deal if you can make it work. It's a lot of fun. But if you are one of those who gets a little seasick, a little nauseated, if you're a little anxious, I wouldn't do it. I absolutely wouldn't do it. I tried day trading for a little while. My results were mixed. And after having done it for a while, I was actually starting to feel nauseated myself. Not anxious, not upset, not irritated, none of that. I felt seasick. I literally felt nauseous to actually sit there and stare at the screen and watch the green and red candlesticks bounce up and down in front of me. So that stuff is really not for everybody. And even this kind of trading isn't for everybody. This kind of trading is basically just for those who want to get into trading and just have fun with trading for a little while and see if they can beat the market averages or whatever their expectations are. And it can provide a little bit of income each year, but I wouldn't rely on it to pay the bills. So just kind of sort of be realistic with it, be careful with it. A little side of caution. I've had 18 trades this year. They were all completely successful, with the exception of MasterCard because I had a sell limit order on that one, and I also had fractional shares because I want to put all the money into it, not just buy shares. I wanted to buy shares plus fractional shares and get the full allotment of money into it. So when I set the sell limit order sold the one share only. And then I had to try and use my fingers to get in there and trade out the rest of the fractional shares. And what I did, I sold on a dip. And selling on a dip kind of sort of put me in a loser's position. And I lost 0.038 cents a share versus 84-cent dividend. So I still walked away with about 80.5 cents of profit on the trade. And that's very, that's very minor, but it's still a successful trade because it still produced a profit. The other trade that I had was PFLT. That one, I bought the wrong week because I hadn't slept in a while. I didn't realize what I was doing. I bought the right day, just the wrong week. But I let the stock price appreciate about the value of what the dividend was, and I took a gain on the shares, but I didn't collect a dividend. So it wasn't a total successful trade, but it was a successful trade enough. So even with the mistakes that I made, I still walked away with profits. I still made money. The other thing is when you come home in the morning after a third shift and you're looking at your computer screen and you see the day is completely green. And this is another thing about sell limit orders. If the day is really green and your stock looks strong and you feel confident, take the sell limit order off. Just cancel your sell limit order and then sell it yourself. Because if it opens on a spike, the sell limit order executes on your price. So try and collect the spike, as it were. Don't sit there and just let it happen. I've had to do that maybe 3 times this year so far. So I don't really get those very often. A lot of times what happens is I buy, it dips. And I'm just like, all right, well, I'll just put in a sell limit order. And then when it gets close to the price, I don't really see a whole lot of pre-market action that's telling me that it's positive one way or another. And then later on that day, I actually do get sold out. And I get a notification on my phone that I sold it. And this is why I call it lazy trader. You're not trading real actively. you're consciously buying at some point during the day. I picked 10 a.m., but you're consciously buying at some point during the day in order to get a purchase. And when you get that purchase at a price that you think is pretty good for that day, you hold on to it to the end of the day, and then you set your sell limit order that night before you go to bed, or maybe when you wake up, you set your sell limit order before the market's open. And then you use good till canceled. That's very important. Good till canceled is a very important thing to implement into your trade. That way you don't have to sit there and watch the computer screen. Each and every single day, you still got your sell limit order because it's good till canceled. If you use just sell limit order, by the end of the day, it dumps your limit order. It's gone. And then you have to reset it the next day. Just set it good till canceled. So if you have to sit there and wait a whole week, you wait a week, it sells. So that's all I got for you on this one. Thanks for watching, and stay lazy.